Greetings, everyone. I am La-Dene Forrester Lambe, currently doing the San Pedro Town Council IPSAS review. This is a case study accompanied by 6 questions as part of the Internal Public Sector Accounting Standards Certificate Program. I will be sharing with you just a brief overview of this case study before I begin. So, just the background, the San Pedro Town Council is responsible for managing the finances of San Pedro, Belize. Its main revenue comes from property taxes, trade licenses, liquor licenses, garbage fees. In March of 2023, the council published its financial statements audited under the IFRS for SMEs framework. So with this in mind, some of the key issues that were identified will be discussed. We saw issues concerning unpaid taxes, accounting framework, inconsistent asset reporting, and we also will be discussing future liabilities. Now on the screen, I have an overview of the themes that will be discussed based on the questions provided. Now these questions are listed on the screen. The first 3 may be seen here, and questions 4 to 6 follow. So let's begin with the first question. Is San Pedro Town Council required to submit a budget in accordance with IPSAS? Based on the case study, we saw that the council's financial statements are prepared under the IFRS for SMEs, not IPSAS. This is explicitly stated in the accounting policies. And then we also saw that IPSAS 24 requires public sector entities that publish budgets to present comparison of budget to actual and explanatory notes. If the council or local legislation requires an approved budget, IPSAS would require disclosure of that budget and reconciliation. Now, because the council adopted IFRS for SMEs, the current financial statement does not include IPSAS budget preparation or presentation. So I would say that under the current accounting framework used by the council, the financial statements do not present budget to actual information required by IPSAS 24. Now, if the council intends to comply with IPSAS, it should prepare and disclose its approved budget and present a reconciliation budget versus actual in the statement of financial performance. So moving on to the second question. This question looks at the components of the statement of position presented by the San Pedro Town Council. Now, the statement of position is really a balance sheet, so to speak, and we're looking at the assets, the liabilities, and the net assets here. So some of the assets that we can identify are the cash equivalents, which would look at cash in bank, undeposited funds, cash on hand. We also have receivables. Trade and other receivables would include property tax receivable, trade license fees, garbage fees, liquor license fees, miscellaneous. Advances and prepayments, property, plant, and equipment. This includes land, building, motor vehicles, infrastructure, work in progress, even artwork. There's investment property as well, which is land held for capital appreciation, and intangible assets like software. So among the liabilities, we listed borrowings, which would be bank loans, government of Belize loan, private party loans, whether current or non-current portions, followed by trade and other payables. Now, account payables, unidentified deposits, employee withholdings, accruals, these would be what we categorize as trade and other payables, followed by severance payable, whether these are current or long-term portions. And then we also have unearned revenues, which include trade license fees, property tax prepayments, liquor fees, garbage fees. So The final category that we have listed here are the net assets, and these involve the opening and closing balances. So balances at the beginning and end of the year. Question number 3 discusses the components of statement of performance the council should present under IPSAS. Now, under IPSAS, a statement of financial performance should include clear classification of the following items. These should be revenue by major classes. For instance, it can be taxes, property taxes, maybe fees, trade licensing, garbage, traffic. If they're grants and subventions, these should be listed. We have exchange versus non-exchange revenue as well. These should be separated. IPSAS typically distinguishes these. Then we have expenses by function or nature. For example, salaries and wages, these are expenses. We have bad debt, expense, repairs and maintenance, depreciation or amortization. There's surplus or deficit for a period, and there's usually a net result. Gains and losses, prior period adjustments, budget versus accrual. There's typically a comparison for those. And then we have other comprehensive income, if any. For example, reevaluations, actuarial gains or losses for pensions. Those are just some examples. Okay. Question number 4. Now, question 4 places a lot of emphasis on the required disclosure notes the council did present correctly. So what did they do right? Now, first of all, they did have the statement of compliance. The financial statement includes many of the key disclosures expected under IPSAS style presentation. And so statement of compliance is one of those, and policies. We also have the accounting framework, and we have the summary of significant accounting policies. There is the property, plant, and equipment, investment property, trade and other receivables, borrowings, related party disclosures, unearned revenue, commitments and contingencies, and subsequent events. There was the statement of cash flow. So the list here summarizes the required disclosure notes that were present in the case study. Question 5 goes on to ask about the deficiencies. So we just discussed, we listed some of the things that they did right. What were some of the deficiencies in the financial statements or the IPSAS? So these are some of the main issues that were present. First of all, there was the accounting framework mismatch and absence of IPSAS specific disclosures. This was an issue because the council prepared the financial statements under IFRS for SMEs, not IPSAS. Therefore, IPSAS-specific disclosures like budget comparison per IPSAS 24, separation of exchange versus non-exchange revenue are not included. The implication for this is that if the assessment question requires IPSAS compliance, then the financial statements are incomplete for IPSAS requirements only. So the recommendation is simply to add IPSAS 24 disclosures and reclassify revenues as exchange or non-exchange where applicable. Now, next on the list, we have the inconsistent statements about measures, basis for the PPE or land and buildings. Why is this an issue? Because not only does the text state that the land and buildings are stated at revalued amounts and that independent appraisals were retroactively applied, yet elsewhere in the financial statements, it states that they were prepared on a historical cost basis. So we see some inconsistencies there. This is internally inconsistent. The implication for this is that IPSAS PPE guidance requires consistent disclosure of measurement basis and reconciliations for revalued classes. So the recommendation here would be to reconcile the wording, disclose the revaluation model details, provide revaluation surplus movements, and present comparative revaluation. Another implication seen in the deficiency of the financial statements application was the large receivable balances and impairment policy requiring stronger support. Why was this an issue? Trade receivables are large with a huge impairment charge in 2023 and an impairment policy that automatically impairs receivables greater than 5 years. IPSAS requires a disclosure of methods or assumptions for impairments and evidence supporting recoverability. A blanket of over 5 years at 100% rule may be acceptable if supported by historical collectible evidence, but the financial statement should disclose aging analysis and recovery expectations. And here, what would have worked is if they had provided receivables of aging schedule, roll forward of allowance, and rationale statistics for 100% write-offs after 5 years. Another deficiency that we observed was the presentation reclassification, where things were not fully reconciled. Now, some presentational classifications were made, but IPSAS 1 requires clear comparative disclosure and explanation of presentational changes, and these are shown but should be clearly explained and reconciled to prior year totals. In the future, they can add a detailed note reconciling prior period figures affected by reclassification and clarify any impact on users' interpretation. Now, the final point that we have in this section looks at accrual application on some items that was not evident. So the issue was that severance payable and certain provisions are estimated. So disclosures exist, but more detail on our estimation methodology and sensitivity would have strengthened compliance with accrual and IPSAS 1. In this case, the recommendation would have been to expand the note disclosures, assumptions, sensitivity, and movement tables for provisions. The Council provided many of the core disclosures and appears to apply accrual accounting broadly, but there were some notable deficiencies. These are the top 3 recommendations that I would have made for this case study. 1, we would have had to include IPSAS 24 in the budget disclosure, clarify the PPE measurements and reevaluation for the disclosures based on the recommendations made in the previous slides, strengthen receivable impairment and aging notes. So, in closing, transparency plus IPSAS alignment equals improved accountability. Following the framework makes a significant difference when we are submitting these financial statements. It gives us a guide in terms of what is required, what should be included, and by following these steps, we can improve accountability. That's my takeaway from this case study. Thank you for listening. Have a good day.